joining us today for a really important and timely conversation about how to navigate today's financial markets is Kevin Oram. He's co-founder of the $2 billion Praesidium Investment Management Fund. As we all know, just a couple of months ago, the markets had hit an all-time high. The S&P 500 was around 3,400, and within just about a month, through mid-March, it had dropped by 35% until its recent rebound. We thought this was an important conversation to have today because the markets impact the lives of just so many people, from individual account holders, 401ks, private pensions, and really importantly, public pensions, making all this, making an acceleration of the economic recovery all the more important. The Adam Smith Society will continue to provide this kind of content, giving people the opportunity to speak with, to hear from experts like Kevin, to more deeply understand and deeply explore the policy challenges, the economic challenges that we face today, so we can work together to ensure that our dynamic economic system continues for many, many years to come. If you're not already a member of the Adam Smith Society, please visit us at adamsmithsociety.com. Now let's get to our speaker. Before co-founding Praesidium, Kevin Oram worked at Sanford Bernstein from 1991 to 2003, where he rose as partner and senior vice president to lead the firm's global technology equity investment practice. Prior to leading his leading role in technology, he worked in a number of different industry areas, ranging from gaming to food to paper. And so, Kevin, I think it's interesting that you transitioned from paper to technology, probably a pretty smart move. Kevin and I will talk for about 15 to 20 minutes, after which point I will open it up to Q&A. Please note this conference is being recorded. You may ask questions in the question box in your GoToWebinar controls. Questions will be read aloud by my colleague, Dean Ball. Please provide your full name and chapter affiliation to ask your question. You may submit your question at any time. With that, let's kick things off. Kevin, thank you so much for joining us today.
Thank you very much. I was thinking about, when I worked at Sanford Bernstein, I worked with Marilyn Fedak, and I can remember way back when I would have lunch with her. I think it was around the time she was retiring from Bernstein, and I had started Praesidium, some years prior. And she would take me through kind of the dreams for the Adam Smith Society. It was just kind of getting started. And to be honest, some of the goals that she had sounded like stretch goals, at best. And it's been incredible to watch this organization grow to, far exceed what would seem to me to be, numbers that would be very, very difficult to achieve in the period that you've been able to do it. So it's been incredible to watch this organization.
Well, sure. I certainly appreciate that. And for those of you who don't know, Marilyn Fedak, of course, one of the co-founders of the Adam Smith Society, and we're always grateful to have her support and her participation in what we're doing. So, Kevin, to kick things off here, first, I wanted to talk a little bit about yourself, your own background, and then talk about the bigger picture, the macro landscape. So first, tell us, why did you start your own fund? How did you get it started? And why the focus for you on value investing, specifically in the public markets?
Yeah, sure. I mean, I guess in terms of why I started my firm, it's been a dream of mine to start my own company since going back to college. So my wife, who I met in 1993, will tell people that the first time we met at a bar that I told her that I planned to work at Sanford Bernstein for a while until I kind of got to a level that I felt comfortable starting my own company. But ultimately, my goal would be to start my own company. And so it's always been in my mind I wanted to do. And so you kind of, when you're at a company thinking about, all right, each year you kind of evaluate it. Have I learned enough? If I stay, I'm going to learn more. And that's always the case. But, to be in a better position a year from now because I'll be more knowledgeable a year from now. But at some point, you have to kind of think to yourself, all right, the growth curve is kind of, flattened out somewhat in terms of your knowledge, and that you're going to, at some point, you got to jump in and do it. So in 2003, I left Bernstein to start Praesidium. Spent about a year getting everything prepared. I started with a very good friend of mine who had worked at Viking Global, one of the original Tiger Cub hedge funds, and who I've known forever. And we launched a strategy in 2004, a long-short strategy, and shifted to what we do now in early 2008. My time is impeccable. I shifted to in March of 2008, we shifted away from hedging to a concentrated long-only strategy right at the beginning of the financial crisis. And we'll come back to that. But the thinking behind value investing, it's something that, as people, I think Warren Buffett has said that you either grasp it the first time you hear it, or you'll never will. And it's one of those things that when value investing, I always think of this business investing, which I've been obsessed with since freshman year in college, as I always keep it pretty simple and kind of go back to the basics. We're buying pieces of businesses, and we're looking to buy companies that are priced at levels that I can buy them at a very attractive price relative to what I think the intrinsic value is. And there's kind of multiple variations of what kind of value investing can mean to different people, but that you either grasp it right away and you fall for it, or you don't. And I think immediately it struck me when I was in college, I would get the Berkshire Hathaway annual report sent to me. Actually, it got to a point where Warren Buffett's assistant knew who I was because I called so many times, because she refused to take down your information, and so you'd have to keep calling back until the annual report was ready, and she would send it to you. So at Sanford Bernstein, it's known for deep research. So when I left college, I really wanted to get to Sanford Bernstein, and I didn't come from a good school, and so I couldn't get into the research department. I applied a lot of times, and finally they hired me in operations there, and then I kept trying to get a job in research. I pushed my way into finally getting a job as a research assistant, opening the mail and answering the phones in the research department there. And to fast forward, within a few years, I was a research associate in 1 year, and I was a research analyst in a couple of years, and I was a partner a few years after that, and was heading up, as you mentioned, technology investing. And Bernstein was a very good firm for that. It's a meritocracy. It didn't matter where you came from, that you could grow there. Bernstein is known for deep research, which was one of the things that really attracted me to that, and so to that firm. So Bernstein is known for learning more about the businesses than anyone else on Wall Street. And so what I did, I learned that process, and I took that process with me and infused it into Praesidium when I started Praesidium. And so the thinking at Praesidium, and we manage, today we manage a portfolio of very concentrated 12 to 15 investments at a time, all in public markets. What we've been able to do is we take the research that we do on the companies. We become really knowledgeable, spend maybe 3 or 4 months studying a company before we invest. And one of the unique things about what we do is we really take a private equity approach to public investing, in that we bring that research that we've done and the understanding that we have and opportunities that we see for a company to unlock value or to add value in various ways. And we bring that research to the board of directors of companies we invest in, which almost nobody does. And we've been able to have a real positive effect on the companies that we've invested in by bringing them, empirical data, to bring them real research to these boards, and helping them understand ways to unlock value. So it's kind of, if you think about it relative to private equity, we like to think of it as, if a private equity firm buys an entire company, they have full control of that company, but they have to pay a premium for that control. We like to think of ourselves as buying, having significant influence at a discount versus control at a premium.
I see. So now you mentioned that you started this new strategy of yours really at the start of the Great Recession, and so I'm wondering, you experienced the Great Recession, you got through that. How does this downturn compare to other downturns you've seen?
Yeah, there was an old timer, he passed away a couple of years ago, that I would have lunch with a few times a year. He was in his 80s. And he'd tell me about different cycles that he's been through in the past that I hadn't lived through. And we kind of talked about, compare different cycles. And he often talked about the 74 to 76 downturn, which was a very significant downturn, the biggest one prior to the '08, as a kind of a period where there was a long kind of denial period where companies, oil prices had quadrupled, and companies that were exposed to that were initially affected, but companies outside of that area, who didn't think that the downturn was going to affect them. So there was kind of a long denial period. So it took companies a long time to retrench, which prolonged that downturn. In '08 was a unique cycle because there was no denial period. Lehman goes under, first Bear Stearns goes under, then Lehman goes under, then Fannie and Freddie get taken over by the government, and the news was just horrific every single day. Banks could drop 30, 40% in a day. And as a result, that downturn, there was no denial period. Companies had no problems going back to their boards and saying, I need to cut costs. Everybody cut everything that was needed, anything excess got taken out. And so what that meant was that kind of made the downturn sharper, but faster. So they cut capital spending, you laid people off, everything. This downturn is kind of interesting. We've been speaking to dozens of companies across a lot of industries. And what's happening now is companies see that there's another side to this, that eventually, that we don't know when the business picks up, and there's various views in terms of whether it's V-shape or U-shape or whatever. But they do feel that there's a light at the end of the tunnel. And so what companies are doing now is they're being careful. They're cutting expenses, but they're being careful that they don't cut too much, because if I cut out a lot of salespeople, or I cut various expenses, and you don't, Greg, and then the economy picks up again. The government opens up the economy again and picks up, and you start taking significant market share from me because I don't have the resources to do it. Then I'm at a huge disadvantage. So companies are thinking along the lines of, I want to make sure that I keep enough in place to be able to ideally grow my market share in this period, and at the very least not lose market share with these. You don't want to be caught, because it's very difficult to go back and rehire salespeople, and it takes a long time, and it's in the meantime, my competitor might be taking a lot of market share from me. So that's kind of what's making this downturn different than '08, is that there is this belief, that it's a strong belief that we don't know how long this lasts or how severe it will be in the next couple of quarters, but they will get better, and we want to be positioned well. And so I think this kind of we're trying to think through kind of the ramifications of that kind of thinking in this cycle versus what the '08, which is cut everything.
Right. And so in talking about how companies are looking ahead, tell us about the importance of free enterprise in accelerating an economic recovery here.
Yeah, it's kind of have to think about it as obviously the government has shut down a large part of the economy, and businesses are not structured for zero revenue for very long. And so what the government is doing, and we're trying to think about the handoff from government back to free enterprise and the importance of free enterprise, both in the short term and long term. And, the government is creating a bridge to get companies through this period, in a way that's going to be have the least amount of economic damage, with the fewest number of companies going bankrupt and going out of business, and plenty will. But doing various things to create that bridge. And I think as long as the government sticks to that, so far they have, where any kind of stimulus is structured around creating this bridge, then I'm very optimistic about the handoff back to kind of free enterprise, as I'm thinking about it as a handoff. I mean, we come into this period, January and February, were some of the strongest. We had some of the strongest economy, arguably, in decades. I mean, and a lot of the CEOs, as well as a lot of top people at private equity firms, told me January and February were record months. You had, as we know, near or at record low unemployment at that time. You had you had more liquidity. Michael Milken had argued that in February we had the greatest amount of liquidity in probably the history of the world in February. You have banks that because of the financial crisis have far better balance sheets. So they have about a third of in the United States, about a third of the amount of leverage that they did in 2008 and 2009 or 2007, 2008 timeframe. So they can lend in this environment, whereas in 08, 09 they had to retrench. So that's very powerful. You think about the technology today. We invest in a lot of technology companies. If this happened we wouldn't, 5-7 years ago, we wouldn't be doing this call, together. And we think about people being able to work remotely. That's really powerful. But and I think the other thing to think about is interest rates are at record lows, and the government is going to have to borrow a tremendous amount of money, but 30-year bond, Treasury bond is about 1.4% today. Over the last 10 years, it was about 3.5%, and the 10 years prior to that was about 5.5%. It was like 6% when I joined, Wall Street in 1990. And you think about the cost. One of the good things is that with interest, and part of it is driven, of course, by what the Federal Reserve is doing. But at 1.4%, if this costs us $6 trillion, that's about $84 billion a year. If this had happened at 3.5% interest rates, which they've averaged over the last 10 years, that would be over $200 billion a year. And at 5.5%, the prior 10 years, that's over $300 billion a year. So it's going to be costly, this bridge, but we're in a good position that with interest rates where they were, that it's not going to be as costly as it may seem. But yeah, I do feel very good about how this kind of gets handed off, as long as they kind of stick to this. And what will happen in the short term is this: you kind of have J. Paul Getty, I think it was, who said that if I owe the bank $100 and I can't pay it, it's my problem. If I owe the bank $100 million and I can't pay it, it's their problem. Now, let's fast forward to today. What if you have 100 people, a million people who can't pay their $100? Whose problem is that? And that's what we're in right now, and that's going to be a system problem. So you have, think about it as the landlord has a tenant, has let's say a retailer or a restaurant who can't pay their rent. If the landlord kicks them out, they have a problem. They can't replace that tenant. The landlord was probably heavily leveraged, so that landlord has interest payments. They miss their interest payment. The lender could foreclose on them, but if the lender forecloses on them, they got a problem, because they would have to sell that asset at very depressed prices and arguably not make up the costs. So somebody described it, I thought, really well. They described it as it's a zero-sum prisoner's dilemma here, right? And so there's, what will happen in the short term is these enterprises have an incentive to work together, and they'll be messy. but to work together to come up with solutions here to get them through this period. And then ultimately that, we will have businesses go under, but hopefully with the amount of liquidity that's out there, there's a lot for these entrepreneurs who are struggling to be able to get more even from private enterprise. And then ultimately businesses that do have to shut down, that there's enough liquidity, there should be with the strength of the economy coming into this and the liquidity out there for businesses for other entrepreneurs to come in and take that place. That's kind of how I see, is why I'm, there are reasons to be, and plenty of reasons to be really down about everything that's happening, obviously, but there are some positive things. Imagine if all this happened in 2008. When the economy was turning and the banks were as levered as they were, and you don't even want to think about what could have happened in that period.
Right. So I want to ask you one last question here, and then I would like to open it up to Q&A to our audience. If you want to ask a question, please submit your question now. Please remember to state your name and your chapter affiliation to ask a question. So to kick off, before we get into the audience questions, let me just ask you quickly here, Kevin, how do you envision the investment world in the aftermath of the pandemic? What does it mean for active managers, value strategies, growth strategies? What are you seeing after the pandemic for the investment landscape?
It's really difficult to say. We tend to react to what's going on in the market. So it's kind of, we watch what's happening and see where there's value. But I would say, if you look today, the market is not, in my opinion, pricing in a V-shaped recovery. And even though you see that the market's up a lot from where it was, but if you kind of look within the market, you see small caps small and mid cap stocks have greatly underperformed large caps. In fact, in the first quarter, it was the widest margin in the history of the indexes. While large caps were down 20%, small mid caps were down 30%. In equity value spreads in credit, just like credit spreads, equity value spreads have blown out to, in small caps, 5 standard deviations. So it tells you that there are a lot of opportunities out there. If companies with bad balance sheets have greatly underperformed companies with good balance sheets. So if the market was actually thinking V-shaped recovery, you really see the opposite happening. Small caps would be outperforming large caps. The companies with the worst balance sheets would be outperforming the ones with the best balance sheets, and you'd be seeing value spreads contracting rather than widening. There are a lot of opportunities. We would argue in small mid-cap stocks right now that they're arguably the cheapest they've been in decades, and so I don't know exactly what things will look like in a couple of years, but I can say that the opportunities today are clearly in small mid-cap stocks. If you look over the last 5 years, the Russell 2000 is actually down over the last 5 years, whereas the large cap stocks are up about 35%. And it's very rare to have a 5-year period where small caps are down. It's happened in only about 5% of time, 5-year periods. So that is where we are. We've never had as many ideas in our pipeline as we do right now.
All right. Well, good advice there to look at some of the smaller caps out there. Again, please submit your questions now with your name and chapter affiliation. And we'd like to kick things off with a question from one of our members.
A member from our Duke chapter asks, your investment strategy implies a preference for public markets. Is that correct? And if so, what is it about public markets that you like?
Sure. It's and by the way, Duke was our original investor. The Duke Endowment is our original investor in this strategy. So I have a special affiliation. They've been incredible to us in our business. So in public markets, there are advantages and disadvantages. Private equity, you do get to control the whole company. Public markets, you don't, but what we like about it is that the public markets give opportunities because of the market is really emotional. And you go through periods like you do right now, where you can buy really attractive companies because, like right now in small mid-cap stocks, if you're a private equity firm right now, and I talk to a lot of them, they can't do deals right now. No one wants to sell their company to them right now in a period like this. No board is very few boards are, unless they're in deep trouble, very few boards are actually contemplating being willing to sell. So they can't do anything right now. And so in fact, a number of them are thinking about getting into the public markets because that's where they see the opportunities. And we get to, take advantage of those opportunities, in the public markets. I think the other, one of the advantages of public companies is that you have more room to alter your capital structure at any point in time. So it's whereas in private equity, you take on a lot of debt, and you kind of all your cash flow is used to then pay down the debt. Whereas in public markets, there's all kinds of interesting things companies can do to change their capital structure over time, which can be beneficial to public investors. So it's just it's an area that that I've just spent my whole career, and it's what we really enjoy at Praesidium.
Max Cohen from our New York City professional chapter asks, value investors identify companies the market has undervalued, but why are value investors confident that markets will correct? If they've undervalued the companies to this point, why do we expect the market to get smart in time for the value investor to make a return?
It's great. It's always the dilemma, when with value investors about, I get that it's attractive, but is there any, what will make it, get valued right in the future? I think you have to have a long-term holding period. At Praesidium, we have endowments like Duke and foundations and very wealthy families because they're long-term investors, and our average holding period is 4 years. And I think what we do is we buy companies that generate significant amounts of cash flow that are selling at very attractive prices relative to that cash flow that they're going to generate in a number of years. And the kind of business, the way we do it is we tend to work with the businesses to help them kind of create some catalysts that will unlock value that's maybe hidden at the company. But ultimately, if the kind of businesses we own, if the market doesn't start to value it right after a period of time, then an acquirer comes in and buys the company, and you get the value that way. And so ultimately, over time, the market does adjust. You get the businesses that were misvalued right. But I think in our case, that we had a good amount, like in our software holdings, which is a big part of our portfolio, we've had about 40% of them acquired over the years. Because ultimately, if the public markets don't value them correctly, the acquirers will, because the acquirers do want those businesses.
Rob Lee, also from our New York City professional chapter, asks, what's your view on the recent trend of the largest tech firms leading the market? How long do you think this trend will continue?
Yeah, we're pretty heavily invested in technology and software in particular, as I mentioned. If you look at what's happened recently over the last, if Rob's referring to the last few years, or if he's referring to the last couple months, let me assume that he means the last couple months. That the companies that have performed the best in this period are the ones that directly benefit from this. What's happening with the economy. Obviously, Zoom and Amazon and Netflix. The next layer of companies that benefit, and we own a number of these kind of businesses, like a company called ServiceNow, a company called Connexus. These are businesses that don't directly benefit from this happening, but what is creating, we're going through this digital transformation in corporate America. That's very significant. It's the most significant trend I've seen in my career. In that digital transformation is being accelerated by what's going on. Because if you think about everyone working remotely, it's getting companies to think, well, I've been planning on this digital transformation for some time. I'm starting it, but there's a sense of urgency now to do this digital transformation. So a lot of these software businesses are doing well because investors like us see that what's going to happen is that ultimately over the next few years, their business is going to be bigger than it would have otherwise have been. So, look, I headed up technology investing in the late 90s at Bernstein, and that was a bubble, unbelievable bubble, and something that we at Bernstein stayed away from and benefited significantly as that bubble, burst in 2000, 2001. This period is nothing like that. This is real. That what's happening. There are a lot of tech companies that are priced really well, and we bought a lot of tech companies in March and April at prices that we think are just absolutely phenomenal. And the underlying trends that are happening, software is eating the world, are very significant in. It's creating, growth for these businesses. Our largest holding, is going to be growing 30% a year for quite a number of years, with a lot of locked-in growth. And we strongly believe that it's, that the valuation is such that we're getting it at a really attractive price. So, I think it can last for, quite a while here.
Ryan Snope from our NYU chapter asks, do you think the Fed's seemingly almost unlimited support of markets is sustainable, or is there any possibility of exacerbating downside when they eventually reduce their balance sheet?
Yeah, of course it's not unlimited. As I was saying before, that right now they're focused on, creating liquidity in the market in a way as a bridge. But yes, their balance sheet does have to get taken down on the other side of this. And if it's not done well as the business picks up, you have all kinds of risks, associated with that. Of course, it can turn, inflationary. It's very difficult to know, though. I don't have a strong opinion on how it's all going to play out, but that, similar to when the balance sheet grew significantly after 08, 09, although this is much more, they have to kind of balance the unwinding of that with kind of, what's happening with growth. And if growth, starts to slow as they start to wind it down, they'll probably slow it down, the unwinding. It's going to be tricky as they do that. I wouldn't want that, John.
Brad from our University of Virginia chapter asks, many value strategies have struggled over the past decade. Do you see this reversing? And what do you think have been the biggest drivers?
Yeah, it's interesting. Active management in general has struggled. Value has struggled. But just active managers have struggled for some time. It's kind of interesting. You can think about, I read somewhere, and it's actually a really good point, that the more participants in the market who believe that the market is inefficient, this is the irony, right, is that the more participants who think it's inefficient, the more efficient it becomes. And because you get more people trying. Conversely, the more people who think it's efficient, then the more inefficient it becomes, right? Because why try if you think it's efficient? Why bother trying? And so what we've had is a pretty big trend to indexing. And what I see is that trend towards indexing is actually essentially more participants believing that it's efficient, which is leading to pretty significant inefficiencies. And one way to really measure value in the market is equity value spreads, which has to do with how cheap are the cheapest stocks relative to the average stock. And when spreads are very tight, that means there's not a lot of opportunities. When spreads are wide, there are a lot of opportunities. Value managers tend to do really well when value spreads contract. And they do poorly when they open up, because if a long short manager, to kind of use a kind of interesting example, along the value stocks and short the expensive stocks, and value spreads blow out and widen, they get hit on both sides. Or if you're a value manager, you do poorly, as those cheap names get cheaper relative to the market. Today, equity value spreads, there's multiple ways to measure it, but no matter how you do it, equity value spreads are some of the widest they've been in history. Not, really, I mean, in small caps, it's as wide as any period other than 2008 and the Great Depression. Those are the only two times that spreads are a little bit wider than they are right now. And every other time, the spreads have been more narrow. And large cap companies, it's not quite that, but it's large caps companies, something like 3 standard deviations above the mean. So equity value spreads are very wide, and there's a good reason to believe that when the economy starts to get better, when the economy starts to open up, there's, I think what you're going to see is equity value spreads contract, which is going to be a huge tailwind to value investors.
Our final question will come from William from our New York City professional chapter. He asks, a private equity firm usually takes board seats and has control. How are you able to sway management in public markets if you don't have a majority share?
Yeah, it's a good question. In our case, we first only invest with strong management teams, ideally with strong boards as well. And there are different, we think of ourselves as constructivists, so we kind of come in and try to work with the boards. There are firms, there's like the Carl Icahns, there's Starboard Value, and firms that are, activists, and they'll come in and throw a proxy battle and try to win a lot of board seats and get a majority of the board in a lot of cases, or a number of board seats. That's not what we do or care to do. In our case, the way we work with boards is we come in with that research, all the research we do, and we show the board that there are, our research. We bring them benchmarking analysis. And what's interesting is that boards typically they don't talk to investors. Not too many firms ever reach out to them, which is something that we saw as a big opportunity if we did. They get their information from the CEO, and it's usually filtered through the CEO to make the CEO look good. And what we have found is that these boards are very open to talking with us if we're bringing them research, we're bringing them benchmarking, we're bringing them true value that they can look at, and that's not filtered to make the CEO look good, but in a way that they can see that there are opportunities. And we've been able to have a pretty significant influence on these boards. We've done a lot with companies, with public companies. You don't have control, so you can't just flip the switch, but you make them do it. But you can have a lot of influence on these boards. If you bring them objective data, objective analysis, and show them that there are things that can be done to unlock very significant value. That's our approach. That's how we do it.
Well, Kevin, thanks so much for joining us today. Thank you, everyone, for spending some time with us. If anyone out there is going to want to profiting from Kevin's insights, you might be getting a performance fee invoice from him in the coming week. So just stay tuned for that. But seriously, Kevin, thanks so much for joining us today. We really appreciate it, everyone. Please stay tuned for upcoming events, and have a wonderful day and a great week. Happy Memorial Day, everyone. We'll see you soon. Thank you. Thank you, Kevin.
Thank you.